We'll hit the record button. And again, thanks for joining this month's Aftermath. We've got a lot to talk about here this morning. We had USDA supply demand report on Friday, which incorporated the June stocks report as well as the acreage report into the balance sheet numbers. So we've got a lot of numbers to look at and some things as we go forward. So with that, we'll kick off. But I wanted to share this slide at the beginning because as I read a lot of stuff on social media, and all of us probably read too much on social media, but you get a lot of people saying that the market has to do this or it needs to do this or whatever. So this was a list that I compiled of phrases you should not use in trading. And it doesn't matter if it's grains, if it's stock market, whatever, but using the phrases always and never, will or will not, must or cannot. You can kind of see some of these here, but this is just from experience over the years. About the time you think that the market has to do something or needs to do something, it will sober you up pretty quickly. And so that's why we always encourage risk management in our business. That's why the insurance business is part of that, but there's different ways to manage risk as well through marketing with options. And so just in case, the market doesn't have to do what you think it's going to do. I want to start off with the heat check this month. Again, you can find the heat check column in the daily email letter here on the front left side of the front page of my market report each day, showing the hot and the not markets. We've got a lot of not markets at the moment in the ag world, especially in the crop markets. Some of the other macros, we'll get into the crop markets here in a minute, but the S&P 500 right now trading at an all-time high once again. It was firmer again this morning, and so being really driven by the big 7 tech stocks right now. So we'll see how long that can last. Again, we've got some analysts out here saying that it won't go higher, it can't go higher, it's ready to turn lower, et cetera, but this thing just continues to run. And so we continue to see more money pumped in each day. Again, AI stocks seem to be kind of running this thing. And you can see what their impact has been as well on the S&P. The cost of U.S. debt continues to climb sharply higher, even though that's not a chart that gets traded or a market that's traded. With interest rates going up, that's just increasing the amount that our debt is costing this country right now. And I don't have the chart, but I did see it the other day that debt has taken over military spending in the U.S. budget as I think the third biggest piece of the U.S. budget. On the cool side, inflation is cooling. It's not low, but it is down. The rate of inflation, I think, reached 3%, first time in a couple of years that's happened. So it's moving in the right direction. Let's just say that right now. Still, everything's still 3% higher than it had been, and so we're not getting those prices back. Consumer sentiment. The University of Michigan puts this out every month, and thought this was interesting that the consumer sentiment right now is lowest it's been here in a few years, and so that's a little bit telling. I think higher interest rates certainly are affecting consumers. I think grocery prices, insurance prices, a number of different things that are affecting consumers right now and causing this to be the case. And then finally, we'll get into the separate crops here in a few minutes. But when you look at the ag position of the funds right now, shortest I believe it's ever been. We'll talk about corn, beans, and wheat. Corn and soybeans funds holding record short positions at the moment. But combined in the ag sector, they were short 661,000 contracts through the middle of last week. And so it's definitely a risk-off trade right now. Funds are betting on big U.S. crops that followed big South American crops. That was a fear of ours back in the winter and spring, that if we have good crops, we could continue to see prices trade lower, and the funds have certainly piled onto this. When you look at the winners and the losers so far this year, Bloomberg had this out a couple of days ago, but through the middle of the year, through the end of June, you can see we've had several commodities that have done well. The crop markets, though, are at the bottom of the chart. You've got hard wheat, meal, soybeans, wheat, corn, all seeing double-digit losses so far this year, percentage-wise. So we'll look at some of the reasons why here as we move on. But to me, the biggest market factors at the moment, crop conditions still are at the top of the list. It's the middle of the growing season. How are the crops doing? We were talking a bit ago, and I was talking to somebody earlier this morning about this being one of the wettest droughts that we've ever had in parts of the Midwest this year. We continue to get some rains. Hurricane Beryl was a big factor in the eastern belt here over the last couple of weeks, bringing some rain into some of the dry areas in that part of the country. So we'll watch crop conditions. We'll get an update here this afternoon. The good to excellent readings will come out this afternoon at 3 o'clock. And again, I don't anticipate any drop this week. The managed fund positions a close second. The funds are continuing to push this market the way they want it to go, and they're really following what the crop conditions do. The seasonals, I talked a lot about that last month, but the seasonal trend of the markets this time of the year is not to go up. It's to go the other direction, and that seems to be what's kind of happening. World wheat crops have kind of moved down the list a little bit. We've seen some better conditions in the former Soviet Union over the last 30 days that have kind of alleviated some of the fears there. And then finally, South American crops are pretty much all in the bin at this point. They're harvesting the second corn crop right now, and it seems to be doing pretty well. And in fact, some of the estimates have raised that crop as harvest has moved on. So really nothing earth-shattering coming out of the Southern Hemisphere at this time. So let's start out looking at U.S. weather. The latest drought monitor out last Thursday still continues to show the eastern Corn Belt and the eastern United States, eastern seaboard struggling. The Southwest struggling as well. I don't know if we've had anybody on the call this morning, but the Northwest continues under drought conditions also. That said, we had seen some beneficial rains over the last 7 days, especially for that eastern seaboard. And I know I've talked to some folks in the Carolinas that were really struggling over the last month. It looks like they've gotten some help. But the biggest precipitation band was Hurricane Beryl that moved up through eastern Texas, western Louisiana, up through the Mid-South, and up into the eastern Corn Belt. Some areas of Arkansas, Missouri, Illinois, Indiana, up into Michigan got some very, very beneficial rains over that 7-day window and help alleviate some of those drought conditions. And along with that, you've seen ample rains in Minnesota and Iowa, Wisconsin. I know this area has been wet this spring, but at some point you've got to continue to get water if you don't have much of a root system. And it looks like some of those states have continued to get some precipitation. And you can see the change in the drought monitor over the last week here on the left and over the last 8 weeks on the right. Net, the eastern part of the country had gotten drier still over the last 8 weeks. So that Hurricane Beryl rains had been very beneficial. And you can see otherwise, it's been a pretty non-existent, drought monitor, I guess you'd say, especially in the western Corn Belt. A lot of focus has been on La Nina coming, and it is coming, apparently. 40% odds here in the June, July, August window, 65% odds by July, August, September. So we know La Nina is going to arrive. When is it going to get here? That's always been the question mark. And how severe will the drought conditions be if it brings drought at all? And so if we look at the forecast for drought over the next 90 days, we're still expecting drought to be developing in the Southwest, where La Nina typically starts bringing drought, but also the drought conditions in the East. But that said, we've had some timely rains in some of these areas that have helped to alleviate some of these drought conditions. And if you look at the next 5 days, this was out this morning, most of this dry area, especially the Carolinas and in through the Mid-South, and the eastern Corn Belt, expected to get some decent rainfall over the next 5 days. So again, just kind of what the doctor ordered at this point. And if you look at the 6 to 10, 8 to 14-day maps this morning, maybe some concern in the upper plains, the Dakotas, where it's expected to be above normal temperatures, below normal precip. But when you've got above normal precipitation in the late part of July for much of the country, that's just hard to ignore. And I think that's what the markets are looking at here this morning. Crop Profit put this out this morning as well. This is what they see as far as change in, I guess, soil moisture conditions over the next 14 days. Again, with above normal precipitation, you've got the southern half of the country expected to improve. This upper part of the country expected to see probably net evaporation and probably start to lose a little bit of moisture. But hopefully they've got enough in the subsoil to be able to continue to keep things going up in that part of the world. So at the moment, at least, not any big concerns. Now, as you get out into fall, August, September, October, here comes La Nina, bringing below normal precipitation up into the western plains, central plains. But is that going to be too late to affect the crops? That's what we all hope happened back when we started talking about La Nina a few months ago, that this thing, even if it shows up, hopefully it'll be late enough in the year that it won't affect the crops. And similar maps from the CFS model showing above normal temperatures, but also starting to bring the below normal precipitation up into the plains. But again, hopefully this will be late enough, may impact some of the later crops. That's kind of what we've thought all year long, is the later crops, maybe like soybeans, for example, double crop beans, probably would tend to be impacted a little bit more than some of the early plantings this year. So we'll see what happens, but right now it doesn't look too threatening for the crops right at the moment. So I'm going to start out with wheat this month. And the reason I'm going to start out with wheat got a very, I guess you'd say, bearish report on Friday. It was probably the most bearish report, and it probably pulled the corn market down to some extent with it when the wheat market traded double digits lower. But you can see the crop conditions. These are some maps that USDA puts out with its reports each month. They do a nice job of supplying the information kind of behind why they did what they did, I guess. And so you can see that, the crop ratings right now, as we start out, we're looking at pretty good crop ratings overall. Not the highest, not the lowest we've had over the last 6 years, but 2024, still above 50% of the crop rated good to excellent. USDA forecasting a winter wheat yield at 52 bushel an acre. That's the highest we've been in, 5-6 years? So nothing to sneeze at there. And you can see which states were better and which ones were worse than last month. The blue states all got a little bit better. The state of Missouri, record winter wheat yield at 70 bushel per acre. We don't have a lot of winter wheat up in Michigan and Wisconsin and Pennsylvania, but we do have record yields there forecasted as well. Texas was down, Kentucky and the Eastern Seaboard down a little bit. But generally speaking, the crop did get a little bit better, up 1.2% here this month on yield. And that takes production to 1.34 billion bushels. That exceeded the 2019 crop. That would be the highest production we've had of winter wheat since 2016. And so, a month or two ago, we were talking about Russian drought possibly being a factor. Now we've kind of flipped the script and looking back to the United States crop, and looks like we're going to have a lot of wheat that continues to come out here right now. Where did that fall relative to trade expectations? You can see the NAS estimate right at the top end of the trade guesses. That's why it was bearish to the market on Friday. Spring wheat forecasting right now a record yield at 53.1 bushels per acre. Holy cow. You look at the states compared to a year ago, that's up 15.4%. Every state that grows spring wheat expected to be better than last year. So again, the Minneapolis market making new lows, kind of driven off of this here this morning. Spring wheat production, even though acres are not as big, 578 million bushels, highest we've been since 2020. And that number was well above trade expectations and consequently was bearish to the market when we had the report out on Friday. So if you look at the overall balance sheet on wheat, USDA did make a few changes. They lowered the export number a little bit from this past year, which raised ending stocks, lowered the average farm price. I believe that's a final price now at $6.96 for the 23-24 marketing year. For the new crop, they bumped acres as was expected, but they also bumped the yield, which was unexpected. And so production rose to 1.875 billion bushels. Couple that with higher beginning stocks. USDA did bump its export number a little bit, but ending stocks were up over 100 million bushels at 856 million bushels. And that was very bearish. USDA took its average farm price from 650 to 570. That's a huge drop in 1 month, and just tells you they're kind of playing catch up with the market. But that's driven by this big jump in ending stocks, highest we've been in 5 years. So that again taking some of the fear away from what's been happening maybe overseas. If you look at the world numbers in this month's report, you can see, the EU crop was dropped just slightly, but the U.S. crop up 3.6 million tons. The Canadian crop up 1 million tons. Beginning stocks were raised as well. So even with higher usage, we're seeing ending stocks at the world level up nearly 5 million tons to 257 million tons. So while there was some talk a month ago, again, that number was 252. Now you bump it up to 257. All of a sudden, things are pretty status quo as far as wheat goes from year to year. And so that's, again, alleviated some of the fears. And if you look at the U.S. and the world situations broken out, the world numbers continue to get a little bit smaller. And this spring, early summer, we were talking a little bit more about the world numbers. But look at the jump in the U.S. stocks to usage, and that has really overridden everything else as far as what the market's doing right now. And so the funds have turned big-time sellers. They've been back and forth in their wheat position this year, though. You go back to last spring, back in April, when the funds were short almost 100,000 contracts of soft red winter wheat, they went on a big buying run. Bought it all back, nearly all back, took their short position from 100,000 to 25,000 short here by late May. And now since then, they've been net sellers once again. And as of last week, they're short about 70,000 contracts of soft red winter wheat. So it's been a risk off, risk on type trade this spring, back to the other side right now. And so Chicago wheat, you can see that when the funds bought back in May, right here from April into May, it gave us a nice big rally in the market. Probably, hindsight's pretty good, but you had the RSI well up above 70. You had the stochastics up in the 70s and 80s. This market was telling us to sell at that time, and now it's just the opposite. I've got this in the not zone right now. You've got the stochastics in the teens. You've got the RSI down at 30. Market's well oversold. Question is, what's going to get it to turn back around following that bearish report on Friday? But we did make a new low this morning, traded down to 532 3/4. I updated the chart this morning before the meeting. So where do we go from here? I would suggest that the first hurdle, of course, will be the 9-day moving average, but it looks to me like the 20-day, the blue line, is really what needs to be exceeded in order to turn the trend of the market. And that's at 577. That's 42 cents above where the market's currently at. So first things first, I think you need a sideways trade. Can we at least stop the downside? And then maybe we can start to try to get some buyers back in and try to go back up over these moving average lines. But if I was have wheat in the bin, if it went to the elevator already and you sold it, it is what it is. If you got wheat in the bin, I'm probably going to eye these longer moving averages, the 100, the 200, the 50-day, something above $6, 610, 612, probably be a good place to have some offers in to price old crop wheat. Kansas City, similar looking chart, made a new low this morning down to 550 1/4. Again, can you break the 20-day moving average and turn the trend higher? If so, probably looking at the 100-day at 622 as a first target, maybe to start making some sales of old crop wheat that's going in the bin. For spring wheat, making a new low here this morning, 585 3/4. And I'm not sure that I got the confidence that we're going to turn this thing. But again, same chart. We've got to break above the 20-day moving average, this blue line. I think that would confirm a change in direction. I don't look for that to happen this week, but if we can at least stop the downside, maybe it gives us a chance for some momentum change as we move into the month of August as we go forward. So I don't want to make any sales here at the present time. The corn market, USDA made several changes to its balance sheet in corn, and they were positive and they were surprising. USDA went back and changed last year's feed and residual number, raised that number. They raised the export number. Now, something I haven't, this is my own hypothesis, I guess, but keep in mind that this feed number is feed and residual. And oftentimes USDA will use this residual column when it wants to go back and make a change to last year's crop size. And I know I've read that people have suggested that last year's crop may not be as big as they thought it was. And a lot of farmers saying that. So because there's not as much corn in some areas of the country. Makes me wonder if USDA is recognizing that same fact and decided to raise this residual number as a way to basically lower last year's crop size. Could be, I don't know. But anyway, they lowered ending stocks to 1.877 billion bushels. That's significant because we've been above 2 billion bushels since last year. And so this is the first time we've actually put a 1 in front of that ending stock number. And that was supportive to the corn market. We rallied corn. Corn had gone down and made a new low before the report came out on Friday. We rallied corn about 15 cents off the low. Then it just kind of stopped. So because I think we started looking at weather forecast and started focusing on the new crop. If you look at the new crop in the balance sheet, USDA did raise its acreage number as they had back in the June 30th acreage report. Most people believe that this harvested acreage number is too high, that number will come down. And I think USDA will probably eventually do that based on some flooded out acres in the northwest parts of the Corn Belt this year. Still, with a 181 yield, would give us a crop at 15.1 billion bushels, gives us 17 billion bushels in corn stocks, which would be a record high. Coupled that with the beginning stock number. So we'll see what eventually ends up with. Now, USDA did bump some demand numbers, both feed and residual and exports, to offset some of the increase in production, still keeping ending stocks just about 2.1 billion bushels. So that number really didn't change, even though they lowered the, we lowered the beginning stocks for this year, but by raising production, it basically offset it. We keep ending stocks above 2 billion. USDA lowered the average farm price a dime to $4.30 in this report. So as we go forward, most of these numbers are fluid. This production number could come down depending on what happens with yield, but I do think harvested acreage number will come down a little bit. I don't know if I'm that optimistic on feed usage. I'm not still hearing the animal numbers necessarily big enough to chew through 5.8 billion bushels of corn. And the export number, I think you got to prove it at this point. And that's a big number, 2.225 billion again. So we got some competition coming out of Brazil with their big crop coming off. We'll see if that eventually happens. But if you look at this chart, this is one I've been showing since last winter. And I continue to go back and compare this year to 2014. And a lot of things had to happen for this to compare to 2014. But a lot of things were setting up coming into this year very similar as we came off of 2013, and that we had cut demand for corn. We were increasing production year on year, both in the United States and in the Southern Hemisphere. And you saw what happened from 2012 to 2014 with prices as stocks grew in the red. And we're in a similar type situation right now. And here we are again with stocks to usage bumping up to 14.2%, USDA estimating average farm price at $4.30. And so that was the reason we were encouraging folks last fall, winter, to step up, the risk management side of things. If you didn't want to forward sell, at least look at the add-on insurance products like margin protection and ECO as a way to protect the high end percentage-wise of price this year. And we'll hit on that here after a bit. Looking ahead, what's going to happen as we go forward in some of these reports? The stocks matrix kind of lays out what could happen if USDA changes harvested acres and or yield. As we sit right now, with a 181 yield and 83.5 million harvested acres, we've got ending stocks just about 2.1 billion bushels. All of these numbers in the green, these combinations, we could take acres down 500,000 to 83 million. But if yield stays at 181, we're still above 2 billion bushels. So just kind of shows you how this would all pan out on the chart. If you got down into the reds, then you're starting to see a rally in the corn market. A 175 corn yield with sub 83 million bushel or 83 million acres would certainly be very bullish. I don't see that happening right now, given the crop conditions that we're seeing, given the forecast. Most analysts, most traders, I think, are thinking we're going to be at least up in this upper 170s, if not above, as far as yield goes. So again, I think that's triggering this risk off trade. And this is also using USDA's demand number at 14.9 billion bushels, which again, I'm a little suspect that we're going to get to that point, but we'll see. So looking at world numbers from the report on Friday, the one thing that stands out there is that the world stocks to usage is going to climb a little bit, 0.2 of a point, which initially that number was expected to drop a little bit. But because of the jump in the U.S. number, that's going to pull that world number up. So world U.S. stocks to usage continue to climb a little bit, and that's not bullish to the market. So here's what the funds have been doing. The funds holding a record short position, 353,000 contracts as of last Friday's report. And you can see what they've done over the last, since middle of May. The funds had bought back a huge chunk of their short position, but now they've been net sellers big time since the middle of May over the last 2 months. But rewind, go back to 2022, 2021, these funds were holding record long positions, just not very long back. And so it's been an incredible shift of their position over the last 12 months or so. But again, that kind of followed that pattern, what we saw in 2013, 2014, similar happening here in 23 and out into 24. So what's offsetting the funds right now? Why would the funds want to be net short so many contracts? Well, you can see what their position is right here, this column, the fund position, short 353,000 contracts. The person that put this table together estimates that the farmers right now holding 605,000 contracts, which is 3 billion bushels of corn. That was as of the June 1 grain stocks report. And so the farmer still holds the key to this thing. Now, that net between the two is one of the smallest numbers we've had for this time of the year in quite a while. However, the funds are really ramped up their bet that the farmer is going to have to sell over the next couple of months as we head into harvest. And so it's going to be a hard tug of war, but without any bullishness in the market, these funds don't have a reason to have to cover that short position. If weather were to turn on a dime here and get hot and dry, then maybe you'd see them get a little nervous. But right now, they're betting that the farmer has to liquidate this corn at some point in the near future, and that's going to continue to pressure the market. So we'll see, but there's a lot of big bets right now here as we move into the last half of July. And so here's a December corn chart. In hindsight, this head and shoulder formation did basically get done. We had a shoulder back in late March. We had the head back in May. We made another shoulder, almost got to 481, got to 478 here in June. And when the market started going down, we've continued to see some big selling, and it's followed the 9-day moving average line lower. RSI right now at 28, stochastics in the low teens, tells me this market's way oversold. Friday, though, we did have a nice day, one nice day. And in fact, the market rallied a little bit Thursday, but we rallied Friday after the report. We had made a new contract low initially, then rallied back up to the 9-day moving average line at the end of the day. This morning, back on the selling side again, with a pretty good weather forecast here as we start the week. So what needs to happen? I think, again, we need to have closes, probably consecutive closes above the 9-day moving average, get above the 20-day moving average to really change the trend if you want to change to a bull trend. And that's 20-some cents away from where the market sits right now. So it doesn't look like that's likely to happen here in the short term. Best I could hope for, I think, is a sideways trade over the next several days. Just looking back at the RSI and the stochastics, you go back to the early part of May, and if you were to go back and look at the heat check column in my market report, we probably had corn in the hot zone. We had the RSI in the upper 60s. You had stochastics up into the 70s, low 80s. Market was telling us to sell. Hindsight looks pretty good. I know a lot of people were hoping we'd get back up over $5, probably had a lot of offers in up at that level and never quite got taken. So the one thing we encouraged producers last winter, last fall to consider were these, the margin protection and the ECO, these 95% policies that at least if you weren't getting any corn sold for new crop, at least you'd have some protection from that. As of right now, we're down 19.7% on the price compared to the margin protection price. We're down 12.2% versus the base price back in February. So the 95% policies would be in the money right now, but it depends also on what your county yield is. So, but at least we know that we do have some protection from these policies, like a put option. And I'll talk about that a little bit more in a little while. And again, go back to 2014 comparison. This chart really shows it from Susan David, how we're really matched up very well closely to what happened with the pattern in 2014. So hopefully that's not the case, because in 2014, we continued well down into the fall window. So what do we do right now? We're getting a lot of questions. I had several people call from a few different states last week. What do you do? There is no magic pill at this point. We've got corn down around 410 as of this morning. If you're nervous about additional downside, well, number one, you've got ECO or margin protection potentially that's going to protect you. But if you're still nervous, maybe you consider buying some put options. Maybe you go buy a $4 put at 13 5/8 cents. That's expensive, kind of. So maybe I could offset that by selling, say, a 450 call, and that would gain me a little over 9 cents. So that would make the net cost of that trade about 4 cents a bushel. And I would have a floor at $4, and I would have a ceiling at 450. So by taking a ceiling at 450, would I be willing to sell December corn at 450? I think this morning, everyone would be willing to do that. And so if I get paid 9.5 cents to do that and can use that to offset the $4 put, that makes sense to me as a trade I could look at this morning. If I really am concerned about a 2014 type washout going down to 350 corn, I can buy that protection for a net cost of 4 cents a bushel. I like that type of a trade right now. And then you've got your crop insurance to help you to the downside as well. One thing about December options now, those will expire in late November. That is a little bit important because your crop insurance protection is going to expire at the end of October. Keep that in mind, because last year that happened. The markets kept going down after October. And if you wanted to really look at some extra, maybe you go out to the March and look at that min-max type trade where I buy a $4 put, sell a 450 call. Maybe it costs you 4, 5, 6 cents a bushel, but at least provides some floor under this market at $4. I know that's not ideal. I know that's not what anybody wants to do, but given where the market sits today, we have to probably reassess what we can do. And again, there's no magic pill on how to trade this thing right now. We hope this thing's oversold, but hope isn't a good plan. And so, if we at least want to protect the downside, that's one way to do it. Soybeans. USDA didn't change a whole lot in the report on Friday. Beans were really kind of a no-show. The government did lower the imports 5 million bushels, took ending stocks down 5 million on the old crop, lowered planted acres 400,000 as expected, took production down 20 million, which net took ending stocks down to 435 million bushels. Still a big number, biggest number we've had in 5 or 6 years. USDA lowered the average farm price a dime to $11.20. So still an ample number here on bean stocks. And again, if you compare stocks to use to farm price like we did with corn, we're still in that similar looking pattern to what we had following 2012, where the market's made its high. The two things that happened really over the next couple of years, demand dropped, acres went up, both in the United States and in South America, and we continue to work prices down as stocks to usage numbers rose. So that's the fear, that we could continue to see that happening as we go forward. So one thing that's really lacking right now, we mentioned exports or usage down, is China. Chinese commitments for new crop just bought a few beans last week. First time this year they bought any beans, and you can see this is the lowest it's been on this date since forever. You know, all of these years, we've always had China in the market. But we know that China is continuing to buy more and more of its soybeans from the Southern Hemisphere. And so we've known that. We've talked about that for a year or so now, that China is going to continue to do that. We need more domestic usage. And so that is happening. Good news. We'll get a domestic, we'll get a NOPA soybean crush report this morning, which is likely to show a record crush for the month of June. So that's a good sign. We're using more beans domestically, but it's not keeping up with the lack of demand that we're losing from overseas. And as of right now, you can see the month of August, U.S. beans in pink priced well above Brazilian beans, a little bit higher in September. But once you get out into fall, pretty much a toss-up right now. And actually, Brazilian beans are more expensive in December. So that's why China's finally showed up at the table last week, bought 133,000 tons of U.S. beans for new crop shipment. We would expect to see more of that here as we go forward. So especially with the market down, I would expect to see China in the U.S. market here in the next several weeks. So hopefully that happens, but it should, given where the price comparisons are right now. So looking at the stocks matrix for soybeans, the one thing I see on this, acres, I don't know how much you debate the acreage number on beans. Maybe you lose a little bit because of some flooding. I don't know. You take 100,000 off, maybe. But if we're up around 51.5 to 52 bushel bean yield, pretty good odds that we're going to be above 400 million carryout in beans. And then you go back to the demand side. Does anything threaten that demand? And if it doesn't, and we carry 400 million beans forward, there's really no reason for this market to rally a whole lot. The other thing I would be concerned about in soybeans right now is the price of corn. And we already are starting to look ahead to 2025. And I saw somebody in the upper Midwest wrote the other day, with input prices where they are for corn, who's going to plant any corn next year? Well, we all know everybody, a lot of people will plant corn, but I would think that the talk will get started early that we could see more beans, less corn for 2025, given where input prices are and given where the price of corn is, what corn margins look like for next year. So if you look at production, I've had this chart in the past just showing Brazil and Argentine production. I decided to add the U.S. on the top. First of all, just look at the blue and the green. Here's your Southern Hemisphere for 23-24. USDA didn't really make much of a change at all. They've still got the combined Brazil-Argentine crop for this year, the crop just harvested, at a record high, just over 200 million tons. Next year, the crop that's going to be planted this fall, USDA is forecasting that record to be broken again. They're forecasting Brazil to bounce back, Argentina to bounce back. And while you can make the argument that this number may be the highest you see all year, it's still a record. And so that's the starting point. And then you add the U.S. production on top of it. U.S. or world production of soybeans, the big three, looks pretty darn big and looks to get bigger in the year ahead. And so I've consistently said over the last couple of months that the bean balance sheet to me is the most bearish of all the crops right now, partly because we grow such a big crop in the Southern Hemisphere now in the world, and because that crop is continuing to get bigger, it seems like, each year. So barring a weather issue, it looks like the bean balance sheet's still going to continue to be a little bit bearish. And again, if you look at, go back to what I talked about a minute ago, China imports, Brazil exports. China continues to buy more of its beans coming out of Brazil. So that's continued to be a little bit bearish. Looking at the world, the U.S. numbers, again, both are bearish right now. We've got a rise in U.S. stocks to usage. You got a rise in world stocks to usage. So nothing real friendly here to turn the bean market. And so this is what the funds have been looking at. Now, they gave us a great opportunity to make some sales back in May when they rallied. They bought back their short position in beans, almost all of it, and now they've turned around and been dumping again. And so as of last Friday, record short 172,000 contracts of soybeans. What's going to get them to turn back on the buy side? I don't know at the moment, unless we get that hot August weather that takes the top off of the bean crop. I don't know why the funds would want to jump back and buy at this point. And so as of this morning, we're traded down to 10.45 3/4. Percentage wise, again, if you look at the crop insurance programs, margin protection, we're down 19.2%. Revenue protection, ECO, SCO, we're down 9.4%. So these 95% coverages, if your county yield were unchanged, you would have a more than a 5% drop in price. So we would be potentially in the money, depending on what your county yields look like. That said, we are well oversold. RSI at 23, stochastics down in single digits right now, which would tell me that this market, I would think, would look for some sort of floor this week. I hope we can trade sideways. Then how do you change direction? You probably got to get again back above the 20-day moving average, the blue line, which we're 60 cents below it right now. So that's going to be a heck of a task. So the first task of the market, I think, would just be to stop the downside. Then can you get any reason for this market to trend higher? Maybe it is the arrival of La Nina as we come into August. That could possibly take a bushel or so off the top of the U.S. bean crop. And if that happens, maybe you get the funds to buy back. Again, hindsight's pretty good, but look back to May, look back to March. You had the RSI pushing 70. You had stochastics up into the 70s, 80s. Market was telling us now's a good time to be a seller. So hopefully we got a few beans sold. Otherwise, we're kind of relying on the insurance program right at the moment. This chart I thought was pretty good, and I could probably go back and do it for all the crops as well. But when you look at the monthly chart over the last several years, and the person that put this out was basically suggesting that we're back down to this channel once again, where we had traded, from 2016 to 2020. And maybe the top end of that channel provides us our initial support. We'll see. But again, charts are charts. So. And then Karen Braun at Reuters put this out at the end of the week as well. I know most of our focus had been on corn prices following what they did in 2014, but you can see that bean price is right now as well. If you look at November beans compared to 2014 November soybean futures, and that year, 2014, we continue to trend lower into fall. So I don't have the options chart up for beans, but I think in beans, you could look at a min-max type strategy as well. Where maybe you look to buy a near-the-money put option to protect downside on price, sell a little bit out of the money call to pay for the put, and take a floor and a ceiling under this market just in case. Maybe today's not the day to do it. But if you get a bounce sometime this week, might be an opportunity to buy a put, sell a call, still give yourself some downside price protection if you're willing to take a ceiling. And I think most of us would be at this point in time. Well, I guess I did put the options in. My bad. So let's look at some opportunities here. We're at 1065 right now. So if I were to look at, a 1060 put basically at the money, well, let's go down a level because I think we're down this morning. Let's go down, say 26 cents for a 1040. If I were to sell the 1140, basically have a dollar window, I could collect about 14 cents. So for a net cost of about, a dime, a little more than a dime, 13 cents, I could have a floor with a ceiling. Something like that might be a decent strategy to look at. If you're really concerned that we could take that next big step down in bean price, then maybe that's something you want to consider. The cotton market, USDA made several changes to cotton, and they were all bearish. They lowered export demand in the old crop, which raised ending stocks. They raised acres, 1 million planted acres, harvested acres, 500,000. That was expected based on the acreage report at the end of June. Raised the yield just a tick, but production went up to 17 million bales. Ending stocks at 5.3 million bales. Pretty bearish numbers. Average farm price down 2 cents to 68 cents. Now, you could argue that this was already in the market because I think given the slide that we'd seen in the cotton market over the last couple of months, most of this was already probably traded. And even after the acreage report came out. And so if you look at the matrix in cotton, similar to what we look at with corn and soybeans, at 800 plus pound cotton, you're still well over 4 million bales of cotton. You probably have to take harvested acres down. Say you go down to 9 million. Now you're down below 4 million bale cotton, something like that. If we get hot, dry, if this La Nina starts to take a toll, let's say in the Texas crop, the dryland crop, and harvested acres fall, then I think that turns the situation bullish. But at the moment, there's been enough precipitation in that part of the world that it hasn't triggered that fund buying that we need, like we'd see in the other markets as well. So looking at the U.S. and the world numbers in this report, both trending higher. So again, nothing here that's bullish. China's economic situation still risking deflation. This article here from July 10th, which normally when China's having inflation is when we see positive cotton prices, but that's not been the case and for several months now. And so this continues to be a drag, I think, on the cotton market. The funds, what are they doing in cotton? They're short. The red shows they're back on the short side of the cotton market. They've reversed their position big time since back in the spring. And that's been the reason that we've seen this big sell-off that we've had in cotton futures. And so, you go back to the spring when we traded mid-80s. That's when the funds were long cotton. We'd had several times where the RSI and stochastics were well up into the overbought type situation. And now here we are oversold. Now, the good news is this morning, cotton was the only market higher this morning. And you can see the RSI and stochastics have turned back higher. And in fact, we've traded right back to the 20-day moving average. And so can you close above it today? And if we do, maybe that changes the trend of this thing in cotton. And maybe then you make a run at 74 cents. Maybe if you take that out, which we haven't really done since back in April, then maybe that gives you a chance to run back to the 100 or the 200-day moving average, which is what I would probably sit tight and wait for some kind of a run like that. Looks to me like a double bottom in the chart down around 70 cents. So maybe we get a little run. If you believe in the symmetry, then that takes you back up maybe to a run at 79.4 cents, like the high we had back in May, or at least to the 200-day moving average. I think that'd be a great place to be looking at hedging some cotton here for this year. So I'm going to change gears a minute in talking about the phrase I mentioned on Friday in my market report, know your position. And I think most of us know what our position is in regards to sales, but also incorporate crop insurance into that. And I've talked about ECO and I've talked about margin protection, those higher level coverages and how they can protect us. So here's an example. These are the tools that I consider to be tools that manage price risk. We have cash sales at the elevator. You have futures hedging through your broker. You can buy puts and calls that can allow you to set floors, take ceilings, etc. But also revenue insurance is a key piece to the puzzle, especially in a year like this where the market hasn't really rallied much and isn't giving us an opportunity to make new sales. So here's an example of why I think it's important to consider and to add your crop insurance into your position. Here's an example of a 1,000-acre corn farmer. Estimated yield, 200 bushel an acre. So this producer estimates that he's going to grow 200,000 bushels of corn this year. Maybe he sold 10% on the spring rally, sold 20,000 bushel an acre, but that still leaves 180,000 bushels that are unsold. And so these are the bushels we're all fretting about at the moment. What are we going to do about that 180,000 corn that we still have left to sell? Well, here's something to consider. You got to step back and look at your overall position. So what is our position? Besides that 20,000, we have a revenue protection policy at 80%. Okay, what's 80% of my APH? Let's say my APH was 180 bushels. 80% of that is 144,000 bushels. I have some price protection, and we'll talk about what that is here in a minute. But we do know we have some. At 86% SCO, if I added that 6% band, that accounts for another 10,800 bushels. And if I have ECO at 95%, there's another 9%. That's another 16,200 bushels. So now my net bushels that I have some price protection on is up to 191,000 bushels. So I'm almost got some protection on my entire anticipated production. I haven't addressed price yet, but we know we have some. And so ideally, of course, we would have sold more to the market and had, maybe doubled up a little bit or improved our price that we've got protected, but at least know that you've got some protection by your crop insurance policy. So what are these prices? Well, my forward sale, if I sold 20,000 bushels, let's say back at 490, I've got that locked in. My revenue protection, now I'm making an assumption right now, and I'm making the assumption at the moment that my yields are going to be right at my APH, and that the county's expected yield is going to be at its expected yield. We know that won't probably happen. There's going to be some counties that are better, some counties that are probably lower. But if my yield was unchanged, then my revenue protection, 80% of this essentially is about a 373. My SCO price would be about $4, and my ECO price would be about 442 if we have an average yield. And so at least I know at the moment that ECO is giving me some protection because we're below 442. So I've got at least some protection on another 16,200 bushels. Again, depending on what the ending county yield is. So I can go back and look in the ECO, SCO indemnity worksheet and figure out how much that protection is worth. And if I were to put in the math today at 466 corn was our beginning price, our harvest price, let's say it's today's price at 409, and I have this ECO and SCO coverage from 95 down to 80%, that band, those two bands, and let's assume that the county yield doesn't change this year, then that right now at 409 corn, those policies are worth $67 an acre indemnity, potentially. And so to me, I'm looking at having some in the money put option protection from ECO and possibly SCO. Mostly all ECO at this point in time because of where the prices are. And I can look at the matrix here and show me that if we have 200 bushel corn, if price continues to go down, how these products are going to continue to give me some protection to the downside. This is why we bought some of these things this year, because we were mainly concerned about downside on price, and it shows that the policy is working for us if prices continue to go down. So it's like a put option. What if we did margin protection last fall? The reason margin protection was a big deal is because of the price at 509. Well, 95% of that is 480. So that's well in the money today if the county yield is unchanged. And so I can look at our margin protection matrix and say, what if? Well, I did this a couple of days ago when corn was at 415. But if we're at $4 corn, and even if the county yield comes in at 105% of normal, now you're $134 in the money right now with this policy. So we've got some great tools to be able to show you how the policies are working for you and or not, depending on what level of coverage you got. The revenue protection policy at 80%, I mentioned, that's below $4 is where that would start to trigger. So right now, revenue protection by itself wouldn't be enough to be able to protect any on price unless you had a loss in bushels. But again, I'm assuming at this point we have an average crop. We know that a lot of places around the country are probably going to be better than that. A lot of places are probably going to be below. And so you can look at your own specific situation in your area of the country and see how these policies would be working for you right now. The other thing I do want to mention, again, crop insurance price protection ends on October 31st. This was the case last year, and it was a big deal last year because after October 31, the markets kept going down. And so we do have this protection from these policies at the moment, but we need to also consider what's going to happen later. And that's why I suggested, well, maybe you look at like the December or even go out to March, like a min-max type trade. If you don't want to sell corn today at 410, then that's a way to at least put a floor under the market just in case this thing continues to go down. If it goes back up, then we can make some sales, or you sold the call option, which could end up being a sale if the market continues to go higher. So there's a lot of different ways to skin a cat right now. Nothing's really, really good at the moment, but at least take a little bit of, at least know you got a little security, especially from these high level coverages that you bought this year. An update on insurance, the winter wheat pricing. We are almost halfway through the month. For the northern states, southern states set their winter wheat prices already. You can see where those are at, $5.99 in soft red winter wheat. Kentucky, Tennessee, South, Oklahoma, Kansas, Texas, Kansas City price was down 14.6%. So, even if you bought 85% revenue protection, it wouldn't be enough of a drop in price to trigger a payment. You'd have had to have had SEO, maybe ECO, or if your yields are not up to your APH, maybe trigger some losses. Where we may see some losses because of revenue are in hard red winter wheat country in the West. You get up into Nebraska and South Dakota, that price is down right now 21% versus the base price, probably going to continue to get lower. Soft red wheat in the upper eastern belt, almost down 15%. So we'll see where it ends up when we're all said and done. But some of the higher coverage levels could end up triggering some revenue losses this year because of the price drop. We are coming up on, and a month from now when we have this meeting, we'll just be about ready to start setting the winter wheat base prices for next year. That starts on August 15th. So I wanted to show you the chart just so you'd be thinking about it. For margin protection insurance, I should have 25 on here. For the 25 crop, we will start setting those prices on August 15th. So we're not that far away. We're just a month out from starting to do that. So start to think. Now it's not too early to start to think about 25 crop. How do we want to manage price risk? Do we want to manage price risk? Are we fearful of prices going down? Well, I put some charts in here just to show you where we're at. D's 25 corn at $4.50 a bushel, basically. Is $4.50 a good price? Well, it's not as good as we were 2 months ago when we were up close to $5, but that might be water under the bridge. What's $4.50 corn look like compared to $4.10 right now on this year's December? Looks pretty good. So should I be locking that in? Well, that's something to consider with margin protection potentially here as we get into next month. Soybeans, 1073, not a real big premium over where this year's crop is. But what do you think is going to happen in the Southern Hemisphere? What do you think is going to happen with U.S. bean acres next year? Is there a chance we could take beans down into that channel that I showed a few minutes ago? Possibly could. Winter wheat, 602, looks pretty good today compared to where nearby wheat's at. Even though we're well down off the highs, still might not be a bad place to start using revenue insurance. Cotton at 74 cents. Compared to this year's prices, we're about 4 cents higher. So again, I just wanted to show you these. All of them are kind of in oversold mode right at the moment. So it's not the day I would probably run out and start doing some hedging, but it might be something to, at least have in the back of your mind when it comes to revenue insurance here as we get started here in a month. So looking at some of what's happening right now. Oh, by the way, today is the deadline to sign your acreage reports, both with your crop insurance agent as well as the FSA office. So we need to get that done by the close of business today. August 12th is our next USDA report. So keep that in mind. The aftermath, I believe I'm going to have to postpone that until the 14th in August. Because I have some travels on the 13th. I don't believe we're going to get to host that on the 13th. So we'll probably push that back a day and maybe back 2 days as we get started. And it wouldn't be a bad thing to have it on the 15th as we're starting to set our prices. So I'll let you all know the date of that here as we get it set up. But it'll be shortly after the USDA report here in August. This report in August is kind of a big one because it's the first one that USDA will start to set its yields. Or possibly change yields based on producer surveys. They don't formally go out and start checking fields in August, but they do take some surveys from producers. And then you can see in September, we'll do it all again. We'll get the September crop report on the 12th. We'll have our aftermath on the 13th. And by that point, I would look for USDA not only to be looking at making some changes to yields, but potentially changing the harvested acreage number too, especially from some of these upper Midwest corn acres. So we'll be looking for that here in the next couple of months. So with that, thank you for joining and appreciate the opportunity. John, answer your question. My summer's going great. Hope yours is as well. And if we have any questions, you're welcome to shoot them at me. If not here, you can send me a text or an email after the meeting. We'll be happy to address those. So thanks for joining and hope you have a great summer, and we'll talk to you again next month.